This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Stocks are losing traction as a $430 billion plunge in Nvidia's value puts a question mark over the AI frenzy and the breadth of the US rally. Also ahead, Beijing said to offer tariff relief for luxury German cars if Berlin convinces the EU to drop its own levies on Chinese-made EVs. Plus, we're live in Dalian, where the WEF's annual meeting of the new champions is getting underway. Exclusive guests, including the LG Chem CEO and Ping co-chief executive.
And of course, Haidi, we're waiting to hear from Premier Li Qiang as well. He'll make an appearance at the Summer Davos Forum. And he'll be also meeting with foreign businesses as well. Of course, plenty to discuss. You mentioned one of them, of course, trade tensions continuing to rise between China, the EU, and other Western nations. And of course, this coming at a very pivotal time for China, right? When we are expecting some major changes in monetary policy as well.
Yeah, and of course, front and centre when it comes to these bilateral talks and conversations is China's industrial policy, right? These accusations of overcapacity. We've seen potential talks between the EU and Beijing on these tariffs, but China's now floating the idea that potentially there's a carrot, perks, right, for German car makers that could be in store if they prevent these EU levies on EVs from taking place. So what we're hearing now when it comes to the latest developments here is that Beijing suggests that Germany's car makers could benefit if Berlin manages to convince the European Union to drop tariffs on these EV exports. So we continue to watch this, but obviously this would be a significant appeal, right, Shery, to luxury automakers in Germany.
Yeah, we'll be watching Chinese EVs at the open of the Chinese markets, but of course those car suppliers also in key focus as we have the setup for the Asia market opens. And the Japanese yen, of course, Haidi, always center stage these days. We're talking about being near that 34-year low, near that 160 level, and the level that we're watching is that 160.17 level that was touched in late April. Japan's top currency official has warned that the government could intervene in currency markets 24 hours a day if needed, but really minimal impact when it comes to the Japanese yen. Take a look at Nikkei futures, really muted right now, but of course we are coming off the back of some losses in the New York session. Take a look at U.S. futures because it was really all about Nvidia and that $430 billion plunge. Nvidia really extending that three-day route, but outside Nvidia and outside of the tech sector, we actually saw some stocks gaining ground. The Dow Jones, in fact, outperforming. Let's stay with Nvidia because our data now showing that this is the biggest three-day value loss for any company in history. Our tech reporter Annabelle Jewelers joins us now, and Bell, it was really a brief stint for Nvidia in that $3 trillion club.
Yeah, Shery, at least this time around anyway. Just a couple of days ago, of course, the story was that Nvidia had vaulted past the likes of Microsoft, Apple to become the world's most valuable company. And now, of course, it's moving in a bit of a different direction. Of course, the stock up nearly 140% so far this year. So you do want to put it in perspective here. But a lot of investors are, of course, searching for reasons of why is this happening and how low is it possibly going to go from here. A couple of different theories as to why that are being discussed. Firstly, this could be simple profit taking place, and indeed we've seen even Nvidia directors and executives offloading the stock so far this year. But there's also possible portfolio realignment because you think we're the 25th of June so far, so just a couple of days before the end of the second quarter. There's also the possibility that there's concerns around AI fatigue, index concentration. So these could all be playing into it. For where we go from here, we've actually been speaking to a few different technical analysts, and what they're saying exactly is that the next level of short-term support could be $115 for the stock. This is near a key Fibonacci retracement level, but essentially we're at 118 now, so 115 probably not too far away. But if we do reach that point, then the next line after that you're looking at is around $100 a share.
Bloomberg Intelligence is also looking at the sway when it comes to AI stocks.
Yeah, and some really interesting findings out of this, Heidi. So they're just looking at the moves in AI now and how does that compare? Of course, we always make those comparisons back to the tech during the dot-com era, but what they're actually finding is that AI is having a far greater bearing or weighting now on the moves of overall benchmarks than tech did going back to the late 90s. And the reasons for that, well, there's a couple of them again, but essentially we're finding that AI stocks are driving a lot more of the earnings growth for the S&P 500 overall. We did not see that for tech anywhere near the same magnitude back in the late 90s. And there's also the size of those AI companies ahead of the AI rush, because before the AI boom got underway, AI companies were still making up nearly a third of the S&P 500. Now it's around 40%, but again, it's a lot higher than tech was going back to ahead of the dot-com era. Also worth noting as well, the market distortions where they're seeing the most of those for AI. There's Taiwan and there's also Korea. And actually, if you took out AI and the AI-linked names around chips, the Kospi would have actually had negative returns so far this year, Heidi.
Bloomberg's Annabelle Drillers there. And let's get some more analysis on this. Scott Halfstein is the head of investment strategy at Global X. Really great to have you and to see you in person, Scott. So I just wanted to pick up off what Belle was talking about. Obviously, a lot of concern over the lack of breadth in this market. And we're seeing, I think, the biggest dislocation in, about 3 decades when it comes to performance versus, of course, the breadth that we see across the rest of the market, right? So how do you, I guess, reconcile that? And is that really a trend that's going to continue, or do you see that widening out of the rally?
So we actually do think it is going to widen out. And Heidi, thank you for having me. It's great to be back with you and Shery. We do think that that's going to broaden out. I actually would argue that the stocks that have been driving concentration were really the winners of the information age or the information era. And that is probably coming to an end as we move into the automation era. And that's going to allow more companies to participate. So mega cap tech, which is really what we're talking about, have been the toll takers of the innovation economy for quite some time. And we're seeing new companies, quite frankly, pop up that are going to be delivering new tools, and old companies like John Deere, who's now making automated tractors and drones and satellites to manage these things. And so we think that that's a really big part of the story. And this will take time to play out. This is not going to, overnight, we're not going to see mega cap tech disappear. They are major players. They're the most impressive capitalist machines the world has ever built. But we do think that it's going to broaden out over time.
And in fact, we were looking at one of the points you made in terms of profitability, right, and profit margins when it comes to S&P 500 companies. And do you expect these levels to be maintained or even extended? And is there a sense that it's almost like we're seeing these very growthy tech names accelerate agnostic to the rate environment?
That is true. And historically, by the way, there is really no empirical evidence that high rates are bad for growth stocks. If we look back over 40 years, there are periods where growth has outperformed at 10% interest rates, at an average of 4.5%, and at an average of 5.1%. So the rate environment is not in and of itself a constraint. When we think more broadly about what's going on in the economy, in 50 years, we've actually seen profit margins expand about 3%. Now, since COVID in the last 4 years, we've seen it expand yet another 3%. So it took 50 years to get from 6% to 9%. It's now taken effectively 4 years to go from 9 to 12. And by the way, we're forecasted to do 13% in the back part of the year. So we've seen 13 straight quarters at 12% or above. I don't think that's a flash in the pan. And even when you adjust it for the really rapid producer inflation relative to consumer inflation that we saw 2 years ago, we're still seeing companies more efficient than ever.
What's the biggest risk for you? I know that you're sort of watching geopolitics. Do you feel like markets are being a little bit complacent about that level of risk?
We are a little bit concerned. I would preface this by saying that we think the economy is really strong in the United States. We think that carries over to a lot of the world. We expect above consensus growth based on corporate investment. So actually my biggest risk is that we do not see a return of CapEx spending like we saw for 10 straight quarters where we got double digits. And that's really what's driving that profit margin expansion. That's helping to drive growth. But geopolitically, we do look around the world, and you've got poor relations between the U.S. and China. You've got obviously the continuing war in Ukraine, challenges in the Middle East, and now even South America with Venezuela and Guyana. Layer on top of that a U.S. presidential election. So we do think investors should be prepared for maybe a little bit more volatility in the back part of the year. We do think, for example, areas people should look at are U.S. infrastructure, which is kind of a bipartisan issue, defense technology, which also is getting a good amount of bipartisan support. So there are areas that investors could be looking at.
Energy security is such an important issue, especially with the rising geopolitical tensions, right? What was really interesting in my conversation recently with Mitsubishi Heavy was how focused they were on the growing defense budget of Japan, but also on all of these other energy sectors that could potentially lead to more growth. Take a listen to what the CEO had to say.
I believe that gas turbines will grow going forward, and they will be combined with carbon capture, hydrogen combustion, and so on. Nuclear power is also a valuable power source in the context of carbon neutrality, so I think it will be necessary to a certain extent as well.
Are you seeing more market interest in these sectors, especially given that the boom in artificial intelligence will also take a lot of energy infrastructure?
Yeah, the International Energy Agency was already forecasting a double-digit increase for electrification over the next decade, and that was really before AI became a factor. We have seen actually quite a bit of interest in uranium and nuclear this year. There's been very strong flows into the fund that we manage in the U.S. as well as here in Australia. So in the United States, it's a little bit different. In Japan, they're likely to go back to turning on their nuclear reactors. Germany might do so as well. In the United States, I think what we want to pay attention to is the small modular reactor technology. And so this isn't, $20 billion power plants. These are small facilities that can be built to power a certain amount of data centers. And keep in mind, we have actually been using this technology hundreds of feet underwater in nuclear submarines for the last 60 or so years. So we know how to do this. We can do it well. We can do it safely. And we do think that nuclear is probably an important part of the energy makeup going forward, given the marginal increases that we're going to see in electricity demand. But really, it's going to take a village. I think it's going to take the entire complex. It's going to be fossil fuel. It's going to be nuclear. It's going to be renewable, wind, solar. We're going to need a lot of it going forward.
Scott, really great to have you with us. Scott Halfstein, who's the head of investment strategy at Global X. We do have some breaking news for you when it comes to Julian Assange. We're hearing reporting by NBC that Julian Assange has reached a plea deal with the US, which would allow him to go free. We know that the Wikileaks founder has been held in a prison outside London for the last 5 years and has been fighting extradition to the United States. We're now hearing reporting that he plans to plead guilty as part of a plea deal with the US Justice Department that will allow him to go free after spending the last 5 years in a British prison. This is according to court documents being cited. Assange, of course, was charged by criminal information, which typically signifies a plea deal, with conspiracy to obtain and disclose national defense information, according to those court documents. These US charges against Julian Assange stemming from one of the largest publications of classified information in American history. That was in the first term of the Obama presidency. And this, of course, Shery, coming after more than a decade of legal wrangling.
Yeah, 15 years, really ending that long overdue saga. We'll get you more on that story, but first, coming up on the Asia trade, we're live to Dalian, China throughout the morning as the World Economic Forum begins its summer meeting. The forum's managing director joins us later at this hour. This is Bloomberg. You're watching the Asia Trade. Beijing is said to be floating benefits for Germany's luxury car makers if Berlin convinces the rest of the EU to drop tariffs on Chinese EVs. China correspondent Min Lo joins us now from Hong Kong. Min, what do we know about these negotiations between China and Germany?
Yeah, it looks like more horse trading happening over the weekend. According to our Bloomberg sources, the Chinese Commerce Minister Wang Wentao had met with the German counterpart Robert Habeck on Saturday in Beijing, where he floated this idea of China lifting tariffs on large engine vehicles, which could affect companies like BMW and Mercedes. And this, is really Beijing's way of dangling carrots and sticks, because previously they had hinted that they could impose tariffs of 25% on these vehicles with large engines. Now, the current tariffs stand at 15%. So the risk is that Germany's automakers could be persuaded to break rank with the European Commission and persuade other countries as well to do so by leaning on German status as the European Union's largest economy. And we know the German Chancellor has so far expressed his wish for a negotiated outcome. He said that there is still time before this provisional tariff kicks in on July 4th, but we are really just less than 1.5 weeks away, so not a whole lot of time. But also there is the wild card that the clock could stop ticking, because some analysts say as long as both sides are moving towards a solution, perhaps the EU could also consider postponing those tariffs until negotiations are concluded.
Canada is also clamping down on imports of Chinese EVs. It's sort of part of this alliance with the Biden administration on trade policy.
That's right. Canada is starting a 30-day public consultation, which is the first stage before it can impose tariffs on Chinese EVs. But it's not just tariffs. The Canadian finance minister said that they are also looking into whether to change the rules when it comes to eligible vehicles that can qualify for a federal rebate program. And she's also looking into whether there should be more restrictions when it comes to investments into the EV sector. So pretty sweeping changes that could come for Chinese EVs. And obviously, Prime Minister Trudeau is under great pressure from foreign and domestic quarters to really match those tariffs by the Biden administration. Of course, the EU has also imposed tariffs of up to 48%. Domestic automakers are also calling for steep tariffs to protect Canadian jobs. They say that Chinese EVs can make cheap cars based on lower labor standards. Now, these tariffs, if they are imposed, they will have a very limited impact on Chinese EVs because they do not have a huge presence in Canada right now. Canada saw a 5-fold surge in EV imports last year, but most of that are Teslas that are made in China.
Bloomberg's China correspondent Min Lo there. Some of the other stories that we're watching this hour. Israeli Prime Minister Benjamin Netanyahu says the intense fighting in Gaza will soon be paused in order to redeploy some forces to the north of the country to fend off Hezbollah. Netanyahu told Israel's Channel 14 that the military will continue its campaign to eradicate Hamas, but switch to more targeted operations. Netanyahu also signaled that he would only accept a partial ceasefire deal. South Korean authorities say 18 out of the 22 people killed in a fire at a lithium battery plant near Seoul were Chinese migrant workers. The cause of Monday's fire is under investigation, but officials say it may have been sparked by exploding batteries at the aerosol factory in Hwaseong City. Fire officials say they'll look at whether the building had fire extinguishing systems and whether they worked. More ahead on the Asia Trade. This is Bloomberg.
You're watching the Asia Trade. Mizuho Financial Group is hiring more bankers after its recent acquisition of Greenhill to take advantage of a rebound in M&A deals. The America's head of investment and corporate banking, Michael Katz, spoke exclusively to us about the Greenhill deal and also growing investor interest in Japan.
As you reported back in May of 2023, we announced the acquisition of Greenhill, which we subsequently closed around December. And that was a great opportunity for us to acquire a premier M&A and restructuring firm to expand our talent and capabilities in the U.S. in our pursuit of building a full-service platform. As you know, M&A constitutes somewhere around 40% of investment banking fee pool, and that was an area that we were underweight in. We had done what I think has been a great job over the last decade or so, building out beyond our lending capabilities, built a formidable capital markets platform in investment grade, equity capital markets, and added on to our leverage finance. But in M&A, when deal activity was actually down over the last 2 years since the high water mark of 2021, we saw an opportunity to lean in and acquire Greenhill. From our perspective, it was what I'd say opportunistic. But what was more unique for us is that it was incredibly aligned with our culture as well as our strategy. Greenhill historically had focused on public companies, more complex transactions. It also had some hidden gem in terms of having a restructuring practice and a private capital advisory in the secondary side, which complemented our primary fundraising business, which we acquired back in July of 2022 through the acquisition of Capstone. And I would say Greenhill was also a global business. As you know, Mizuho is a global bank. Our home market is in Japan, but we have offices worldwide. And Greenhill has 15 offices worldwide. And so there was an opportunity for us to add on to talent, add on to capabilities on a global basis. And what's interesting is that Mizuho had power allies in the power, energy, and infrastructure space, as well as TMT. And Greenhill had great capabilities in healthcare, industrials, and consumer. So putting it all together has been, at least at first blush, incredibly interesting. And then 6 months in, as we're working together, we're already beginning to see some of the fruits of those, I would say, assumptions and expectations.
You were very recently in Japan as well, and investors have a lot of interest right now in the way Japan is growing and reaching out to the broader investment community. What did you learn when you were there?
No, that's a great question. We've seen a pivot toward Japan as the stock market had rebounded, but more so with the government and the regulators' guidelines to corporates, particularly mid-market, to change their mindset and be more open to foreign investment. So in my trip 2 weeks ago, I would tell you that the dialogue has been incredibly engaging. We also hosted a couple of CEOs who had come into Tokyo to take an assessment of the market. They wanted to see firsthand and get input, get advice as to how to get into the market, whether it be through a build, buy, or partner strategy. What's interesting is when the governments had looked at how Japanese companies are trading, they noted that 40% of the top 500 companies are trading at less than 1 times price to book ratio. And so there's been great focus on improving that ratio, improving capital efficiency to deliver a greater ROI. And so that has brought in interest not just from corporates, but also private equity and investors at large.
Mizuho is America's head of banking, Michelle Katz, speaking exclusively with our colleague Shanali Barsak. Let's take a look at what we're watching when it comes to FX at the minute. We're seeing a pretty steady picture when it comes to dollar yen, really not venturing too far from that close to 160 handle, trading against, of course, what is still quite a bit of momentum in the US dollar. 160 is not really kind of the level that traders are watching at the moment. They're now seeing the yen slumping as far as 170 in this time. The yen within range of that recent intervention level. Of course, we've had quite a lot of verbal jawboning, but the threshold for acting seems to be a little bit higher now, given that largely we're seeing analysts say that short-term intervention simply does not work. So that risk there when it comes to dollar yen is sliding to levels seen last in 1986. More ahead on the Asia trade. This is Bloomberg.
You're watching the Asia Trade. Here are the latest from the corporate front. UBS has agreed to sell the majority of its stake in Credit Suisse's China venture to a Beijing-backed fund. The sale values the brokerage at around $253 million. Beijing state-owned assets management company takes an 85% stake, leaving UBS with 15%. The deal is a blow to the ambitions of Ken Griffin's Citadel Securities to expand in China. The Fed is said to have shown other U.S. regulators possible changes to its bank capital overhaul that would significantly lighten the load on Wall Street lenders. Bloomberg sources say the revisions could lead to a 5% increase in the capital cushion that large banks need to hold. That's down from about 16% in the original plan, which faced resistance from lenders and some Fed officials. Haidi.
Let's take a look at how we're setting up, Shery, when it comes to the futures session, getting into cash trading in just about half an hour or so. This is a picture, a little bit of divergence there. We're seeing perhaps some further weakness coming out of Japan. Of course, there's a big question mark at the moment, certainly for some institutional investors, in terms of whether we've seen kind of the last of this Japanese equity rally for now before we see concerted action from the Bank of Japan. That yen weakness element is also weighing on Japanese equity sentiment as well. Across the region more broadly, though, we're seeing equity benchmarks set to trade within pretty tight ranges. It was a mixed day on Wall Street that we're carrying off the back of a lot of speculation, of course, with the move in Nvidia, the extension of that sell-off, that the tech sector rally may be running out of steam at this point. So we're seeing Hong Kong, Australian futures looking pretty muted at this point. Well, the World Economic Forum's second biggest meeting of the year is getting underway in the Chinese city of Dalian. This is the 15th time leaders have convened in China for what's dubbed Summer Davos, and the global economy, the potential of technology will be in sharp focus. Our Chief North Asia correspondent Stephen Engel is in Dalian with our next guest. And Steve, I'm tempted to say that you've probably been there for maybe all 15 of these Summer Davoses.
Yeah, I have been here for all 15 of the annual meeting of new champions, also known as Summer Davos. This year, it is in Dalian. It alternates between Tianjin and Dalian. The last time was in 2019 here in Dalian. We all know what happened in 2020, 21, 22, the pandemic. So this is the first time back in 5 years, and it's great to be back in this Dongbei city up in the northeast of China. And we're going to kick things off here with Mirek Dusek. He is the World Economic Forum Managing Director. Also, you kind of lead the strategy and the planning for these large-scale meetings, including Davos and in this part of the world, here at the annual meeting of new champions. New frontiers for growth is the theme for this year. How do you see the dialogues going at a time, obviously, when there is a bit of a bifurcated geopolitical situation and economy over those last 5 years? Are the discussions going to be a little bit different than in years past?
Thanks for having me on. Yeah, we're also happy to be back after 5 years in Dalian for the annual meeting of the new champions, Summer Davos. This is overall our 15th time we're doing this second largest gathering that we have annually. And the topic, New Frontiers of Growth, is really related to the format of this meeting traditionally. It's always been basically 3 meetings in one. It's always been a global meeting, always an Asia meeting, and always a China meeting. And finding new sources of growth, next frontiers of growth, is relevant to all 3 dimensions. The global economy is going to be front and center here. Kristalina Georgieva said that if we don't find new sources of growth, we'll look back at this decade as the tepid 20s. So we are in a low growth environment historically with 3% growth, as you know. And so really it's so important that we have this platform around the global economy at this quite a fragile time. Of course, some people say, okay, we will have maybe not the hard landing this year as we have some expected, but long term it is clear that we need to find new sources of productivity and growth. And then, of course, the Asia dimension within this tepid growth globally. 2/3 of global growth last year and 2/3 of global growth this year is expected to come from Asia. So we are in growth markets, and so it's so important that we have leaders from Asia here, as well as, of course, other geographies around the world.
Well, given the headwinds, obviously, in the domestic economy here that are tied to more geopolitical issues as well, is there going to be a lot of hope, would you say, that China can still, despite its fairly lackluster growth so far, the engine for global growth?
Yeah, I think what is going to be at the core of the meeting is really this situation of two worlds, if you will. On one hand, you have, of course, as you mentioned, a more complicated geopolitical environment globally, a more competitive geoeconomics, if you will, and that's something that I think people will agree we've entered, if not a new era, it is a transition to something new where we see more competitive relations. But at the same time, we really live in the best of times as well, you could argue, in terms of the number of transformative technologies, not only within the digital economy, but also, for example, energy transition technologies and others that could really unlock new productivity for sustainable and inclusive growth. So it's really about the balance of how do you make sure you navigate the new geopolitical environment, but at the same time are able to take advantage of some of these opportunities for increased productivity, inclusion, and sustainability.
Not to continue to take the devil's advocate position, but that's my job as a journalist, obviously. But the problem, again, is this inclusive growth. How does that happen in areas like AI and climate change technologies when the world is becoming increasingly bifurcated, in isolation?
Yeah, no, I think, of course, it is, and you also saw it at the annual meeting in Davos. These are transformative issues, transformative technologies. They have huge upside. At the same time, we work a lot with all stakeholders also to manage the risks and look at what are the guardrails that need to be put in place. If you take AI, of course, there is a lot of dialogue on that. So we're quite clear-eyed, and you will see here also at this meeting in Dalian, we're really putting this multi-stakeholder model to work to make sure that we have a realistic view of those issues. But it is, I think, there is a consensus that the upside is very considerable. And you asked about China, so you see decision makers around the world, including in China, of course, looking at also clean tech, of course, high tech, looking at those things in terms of how can it unlock new productivity and new growth.
And that goes back to my overall theme of questioning, and that is new productive forces is what's being pushed by the Chinese government. But that, too, has caused some consternation in the West because of the rise of protectionism, in particular in the new three that Xi Jinping has advocated, that is solar power, obviously EVs, and batteries. But it's created tension. We have the German vice chancellor in China this week trying to diffuse that kind of tension. So I think the stakes are pretty high, right, with new productive forces as being an engine of growth for China, but a source of consternation in the West.
So I work with leaders from around the world. I also happen to work a lot in Europe. And if I look at it, and it's really, you see decision makers, be they leaders of businesses or leaders of governments, really grappling with the same issues in terms of we, again, have really a huge economic transformation, huge changes in the global economy, huge changes in the business models. And so it is really how do you, again, navigate this more competitive environment? How do you, if you are a country, and this is not only in China but elsewhere, how do you manage your economic sovereignty and economic security, but at the same time, how do you ensure that you are able to have productive relations with the rest of the world? So these are things that are, I would argue, not unique, for example, to the Chinese economy. We see it also with other decision makers around the world. And if I were to really zero in on the key issues. If you, for example, even look at Europe, the key issues are really managing the energy transition. How do you make sure that you marry the green economy with competitiveness in the future? And then, of course, it's high tech and AI. And so both those issues, let's say high tech, AI, and the energy transition and the intersection is at the heart of the competitiveness of the future, and it is, of course, relevant here, but it is also relevant in other geographies.
It's really managing the competition competition that has really kind of escalated to the point of the rise in protectionism. And we've seen that in Europe with the rise of more right-wing, more conservative, more nationalist lawmakers, which simply complicates the dialogue of globalization, right? Which is really key to this part in this meeting here.
I think if I look at it, for example, if you look at what is taking place in terms of economic diplomacy, for example, you mentioned Vice Chancellor Habeck, but also if you look, for example, at the visits and the number of visits in the U.S.-China relationship, we've seen over the past year number of U.S. officials here, then of course also Chinese officials there. We saw the summit in San Francisco between the two presidents. So, of course, again, we are in this new environment, but I think what we also need to acknowledge that there is a lot of these leaders are trying to figure it out. So they're trying to figure out the swim lanes in terms of, okay, this is a little bit of a moving target. All these technologies, new opportunities. At the same time, we have let's say, changing geopolitics. But I have to say that I do see genuine efforts to figure it out. You saw that Habeck was here. You also saw there was a call, Dombrovskis with his counterpart in China. Now they have a formal dialogue on EVs, on the U.S.-China relationship, a number of things that have been worked on the economic front over the past year. So I think, again, what is important is that, number one, you see officials that are conducting this economic diplomacy. And again, zeroing in back to this meeting, we are a multi-stakeholder platform, global. We will have leaders from around the world here focusing on the global economy. And a lot of the dialogues here will also focus on some of these issues that are pertinent to these very important economic relationships for the global economy.
Mirek, Dusek, thanks so much for having us here again at Dalian, first time in 5 years as you're conducting now. Is this the 16th annual meeting of New Champions?
15th.
This is the 15th, so 14 in the past.
Yes.
This is the 15th. Okay, going to send it back to you, Haidi.
Right, I'll pick it up from here. Stephen Engel, our Chief North Asia correspondent. Of course, he'll be back covering the World Economic Forum in Dalian with more conversations. We have more ahead on the Asia trade. This is Bloomberg.
Well, Xero is a global small business platform that offers accounting solution, payroll and workforce management software. With almost 4 million subscribers, users rely on their apps to connect to banks and financial institutions to run business and manage finances. Let's talk about the business outlook. Joining us now is the CEO, Sukhinder Singh Cassidy. Sukhinder, really great to have you with us. So I'll start off just asking broadly when it comes to the outlook and the level of demand that you're seeing from clients.
Well, you know, I think Xero continues to see very nice and strong demand across the markets in which we play. As you know, Australia, New Zealand, the UK, the US, Canada, Singapore, South Africa. And I think it's because of what we do, which is, you know, we're a tool to help you get online as a small business and get your finances sorted, which we think serves you well in good times and certainly also in uncertain times.
A lot of these markets are facing some challenges, though. QuickBooks Online in the US, for example, is making very fast strides. What's your strategy to catch up?
Well, interestingly, I think we enjoy the benefit around the world, including in the US, of having really loved software that has two channels, both the direct channel and accountant and bookkeeping channel. And in the US specifically, you know, while we're smaller than QuickBooks, I think the accountants and bookkeepers we work with really appreciate that we run an open ecosystem, as do the small businesses we serve. You can hook us up to Gusto, you can hook us up to Melio, you can hook us up to Bill.com. And if you know anything about the US, you know it's a mix and match fintech ecosystem. So our positioning is one that's quite open relative to other competitors.
Are you concerned about revenue per user being low compared to QuickBooks Online in the US? Is there a strategy to try and close that gap?
Well, interestingly, around the world, we have said our strategy is a dual strategy. Number one, to keep growing subscribers. Number two, to deepen our penetration and usage of our products. And so I think we have noted to the market that, you know, while Xero has historically grown subscribers at a very fast rate, over the last few years, we're starting to increasingly focus on growing ARPU, as you noted. Now, that's a function of what products and services you offer, like payroll and payments, as an example, as adjacent jobs to bookkeeping or bill pay. But it is also a function of just deepening and changing our product mix and making sure that customers know that we have a variety of SKUs that they can use. So certainly we're on a journey to increase ARPU, but not taking our foot off the gas on subscriber demand either.
And then in markets like Australia and New Zealand, we're obviously looking at pretty good levels of penetration already. So what's your strategy there in terms of taking it to the next step?
Well, I think you've noted that despite both these markets, Australia and New Zealand, having quite deep penetration, we continue to see strong subscriber growth. But as we think about growing Xero into the future, we talk a lot about what we call, growing those super jobs, making sure that we have, all the things we need in our payroll product, starting to extend our products like adding time and attendance scheduling as an example. So in markets that are very well penetrated, while we continue to grow the core, we also keep adding new jobs. We recently announced, for example, a partnership with Deputy, the leading time and attendance solution in Australia, to in fact extend our functionality further and serve not just the subscribers we have, but to keep growing our TAM in those markets.
What's your confidence level when it comes to investment and hiring at the moment? Are you looking at making more hires?
I think we have been on a journey at Xero, which is, I'd say, to balance high growth with profitability. And as you know, this past year, not only did we return to profitability, we reported, on 22% top line growth, we reported EBITDA of almost $500 million, or over $500 million, and a 75% rise. So I think when we look at our outlook, I would say measured hiring. We think a lot about deploying our capital in line with our 3-year strategy, which we shared with the market just in February. And I think our belief is that we want to be kind of controlled and smart allocators of our capital while we continue to add headcount.
Sukhinder, your background has impressive levels of corporate activity, of M&A activity. So do we take away from that in terms of what the plans are for M&A or potentially even a sale? What's your sort of goal in this role?
So I think at Xero, our goal and my goal is to grow our footprint and our impact for small businesses. And I think we have always been programmatic acquirers. If you look in our history, a lot of our Australia functionality was in fact built through acquisitions. And in recent years, we've continued that trend. So I certainly would expect, as we are now profitable and, obviously growing our cash flow as well, we just recently refinanced our convertible note, that we do see programmatic M&A as a way to keep growing Xero's footprint. We're focused on growing our impact and see systemic M&A as a way to do that.
Sukhinder, we really appreciate your time today and for joining us. Sukhinder Singh, Cassidy, who's a CEO at Xero. Let's broaden out the look when it comes to the payments industry across the region, and in particular when it comes to environmental impact. Bloomberg Intelligence in a new report saying that Australian payment companies' environmental disclosure is substantially better than their Asian peers. Xero is actually a front runner. Bloomberg Intelligence senior analyst Matt Ingram joins us now. So we've just been speaking to the Xero CEO. They're actually well placed. So where and how do you see the progress in this aspect?
G'day, Heidi. Yeah, look, Xero is frankly miles ahead of its Asian peers across the board, whether it's committing to adopt TCFD. They've actually got some biodiversity policies which makes them really stand out. That's important given the change of legislation here. Their emissions are quite low and they've offset those since 2019. So they've actually got net zero emissions. They've committed to net zero for their clients by 2050. And across the board, their disclosure ticks a lot of boxes. So in terms of that risk management, we think they're really doing well.
Is that a similar standard with other Australian payments companies?
Yeah, the Australian companies, so EML and Zip and Tyro are also definitely above their Asian peers. Biodiversity policies are lacking for those companies, but their emissions are much lower. They have committed to TCFD, and I think generally speaking, yeah, those Australian companies are also above the Asian on the disclosure, but also on the emissions.
Southeast Asian players, though, not faring quite so well. Why is that in terms of emissions?
Yeah, look, in a way, Heidi, it's yes, they are standing out as having very high emissions. To be fair to them, they are much lower than the MSCI FinTech Index. I think more than half lower. But also they've got different business models. Xero, as the CEO said earlier, is largely an online platform. Their emissions come from data centres and basically generating electricity. C and Grab have massive vehicle fleets. Their businesses involve deliveries and moving cars back and forth, and so their emissions are so much higher because of those car fleets that they have to have because of their owner-operator drivers. Yes, their disclosure isn't as good as well, and I think partially that's just the pressure isn't there locally, whereas we've got some big super funds here that really insist on having that better disclosure in Australia.
Yeah, that's interesting. So that sort of pressure point is one of the incentives, I guess. Is there sort of massive regulatory differences too?
Regulatory differences, well, yeah, clearly we're at the forefront of a lot of that. Probably not where Europe is, but I think we're at the forefront of that regulatory push. These companies aren't as tightly regulated on this type of disclosure as the banks and the insurers, but certainly I think high water floats all boats, and I think if your peer group in the financial sector are encouraged to have high disclosure, then that clearly benefits the market as a whole, and that's what we're seeing with these Aussie payments companies.
Bloomberg Intelligence Senior Analyst Matt Ingram there. Shery?
All right, Heidi, we have breaking news out of Japan. We're getting those services price numbers for the month of May. Japan services PPI coming in at growth of 2.5% for the month of May. Now, this is a little bit of a softening from the previous month when we saw growth that accelerated at the fastest pace in 31 years here in Japan at 2.8%. That growth was revised downwards for the month of April to 2.7%. The final number for the month of May, PPI services at 2.5%, is also missing expectations of an acceleration to 3%. But suffice it to say that this is a number that we're paying more close attention to these days because this is a measure of the cost of a range of goods and services provided by businesses to other firms and government entities, which has accelerated because of the weaker yen. What this means is that it could support the case for the Bank of Japan to raise rates again. We are now seeing it for the month of May coming in at 2.5%. This is Bloomberg.
The latest tech stories that we're following this hour. ByteDance is said to have discussed a potential collaboration with Broadcom on an AI processor. A source tells us the companies have talked about a 5-nanometer purpose-built chip to ensure a steady supply to the TikTok parent. Reuters earlier reported that the proposed chip would comply with US trade restrictions on China. Tencent's new blockbuster game Dungeon and Fighter Mobile has taken the top spot in China within a month of its launch. Industry tracker Sensor Tower says the game brought in $270 million on iOS during the period, beating other titles in downloads and revenue. The Nexon-produced game is now widely seen as the best candidate to generate recurring revenue for Tencent.
And Heidi, we're seeing a little bit of support for those crypto assets that took a hit overnight as we continue to see that risk-off sentiment spread. The losses now piling up in the crypto market after their second worst weekly decline of 2024. We're talking about Bitcoin seeing the biggest intraday decline since April 13th. We're seeing a little bit of upside in the Asian session, but still not enough to really curb that 10% plus loss in the past few days. The market opens in Sydney, Seoul, and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. And Heidi, of course, we're keeping a close eye on whether that risk-off sentiment that we saw overnight, given that wipeout by Nvidia, translates into the Asian session as well.
Yeah, and increasingly there's this concern, Shery, about the lack of breadth when it comes to the US equity rally, right? We'll be watching to see if that improves or continues to deteriorate. At the same time, also watching geopolitics. We've got Summer Davos getting underway, and of course a lot of focus when it comes to these EV tariffs.
Yeah, Premier Li Qiang will make an appearance at that summer Davos, and we'll be watching what he says when it comes to geopolitical tensions. But of course, we're always these days, Heidi, on yen intervention watch. The Japanese yen still trading at that really narrow range when it comes to that 34-year low achieved back in April. We're talking about that 160 level. And right now, we're trading very close to that level. We got the May services producer price numbers rising 2.5% year-on-year, slightly below what economists had expected, but that weak yen really translating into services inflation as well. We continue to watch any comments coming from government officials after the Vice Finance Minister Masato Kanda, who's of course a top currency official, again verbally warned against the Japanese yen weakening so much. And given that we had that wipeout of $430 billion plunge in Nvidia overnight, we're watching in South Korea those semiconductor names as well. We had seen the Kospi already under pressure, and the Korean won also falling near its 2-month low level. We'll be watching the open today, Heidi.
Take a look, Shery, in terms of how that staggered open is coming online when it comes to trading here in Australia. We did see futures looking like a little bit of muted upside, if you will. Certainly one of the better performers expected in what is largely seen to be a pretty range-bound session that's low on conviction at this point here in Asia. We're seeing a tiny bit of upside there for Aussie stocks as we get online. The Aussie dollar holding pretty steady at 66.56 at the moment. And broadly, we're seeing the potential for really some fluctuations when it comes to Asian equities, particularly in light of what we've seen with the big tech stocks and Nvidia overnight. Taking a look at treasuries there as well, this sort of Fed uncertainty certainly driving what we've seen as not a whole lot of consistency overnight in those 3- and 6-month T-bill auctions. Let's get some more on the market action with our executive editor for Asian markets, Paul Dobson. And we've been watching Nvidia and just this ascent that seemed relentless quarter after quarter with the numbers, right, and the market reaction. Are we now finally getting to the peak, and are we seeing now perhaps further dislocation between what we see in these big mega cap tech cohorts and whether the rest of the market can play catch up?
Yeah, good morning. I think it would be a brave man to call the peak for Nvidia, given the scale and the pace and the size of the rally that we've seen, as you were saying, over recent months and quarters. And yeah, there's certainly a decent check to the rally coming through here. Now, it had gotten to very extreme valuations and people have been piling into ever riskier bets on it. We saw big accumulations into ETFs that are 2 times leverage, for example, looking to capitalize, expecting that the rally would just keep on going. But of course, once it gets too far, then it makes sense for there to be some kind of correction. I feel like we're heading into quarter end, we're heading into the end of the first half of the year as well. So there may be people having a look at rejigging their portfolios. That's going to be in play this week for sure. And in general, that tech rally has been burning everything so high that it makes sense for people to be having a look at rebalancing, to be looking across and, kind of reallocating to the rest of the market where there has been that lag. Question is, I guess, is the rest of the market's lag telling us that there are concerns about the economy, or is it time for that catch-up? And, is there a prospect for that? There's definitely more concerns about the economy right now than it feels like there has been for a while. And so, perhaps that's going to set some broader caution for equity markets heading into the end of the fiscal first half. Oh, sorry, the annual first half.
Paul, should we be watching also how equities react to this fast depreciation that we're seeing in the Japanese yen? I mean, I've been watching that 160.17 level, which was the low in April for the year, and of course near that 34-year low. But what I'm hearing these days is now the 170 level should be watched.
Yeah. So I think some of the FX market is already focused on how much weaker can it go from there, no matter what the pushback from the Japanese authorities could be. And even if we were to see some more physical intervention, several people that we've been speaking to have been saying that would be a mere setback. The interest rate gap between Japan and the US is just so wide, they're saying. There's nothing really that they can see that would be big enough that would cause a proper turnaround in momentum on yen-dollar at the moment. And by the way, not just against the dollar, but also, we're very close to record lows against the euro, for example, as well. So it is a general weakness in the yen, and because of those low interest rates. So what we might see, of course, going into the second half of the year is signs from the BOJ that it's getting closer to hiking interest rates some more. And maybe that will give the yen some support, but it does still feel like there's a lot of bearish sentiment out there, a lot of people still looking for further weakness. And so why not 170?
Yeah, I wonder if some of those safe haven moves can give the Japanese yen a boost. Our executive director, editor for Asia Markets, Paul Dobson, there, and we let him go. And the reason that I talk about perhaps some safe haven moves is because we continue to see these geopolitical tensions ramping up, right? Beijing now said to be floating benefits for Germany's luxury car makers if Berlin convinces the EU to drop tariffs on Chinese EVs. China correspondent Min Lo joins us now from Hong Kong with the details. And Min, what do we know about the negotiations between China and Germany?
Yes, China is now floating the idea of lifting the existing 15% tariffs on vehicles with large engines that are coming in from Europe. This would affect companies like BMW, Mercedes, Volkswagen, and this is really Beijing's way of dangling carrots and sticks for Germany, because previously Beijing had hinted at imposing 25% tariffs on those very same vehicles. And we know Germany has been one of the strongest critics of the EV tariffs so far, saying that it could spark a trade war. Now, this exchange had taken place on Saturday, according to our sources, between the Chinese Commerce Minister Wang Wentao and the German Economic Minister Robert Habeck. And we know the German Chancellor himself had said that he would prefer a negotiated solution. He says there's still time before the provisional tariffs kicks in on July 4th. And we know Germany has this massive auto sector that could really pressure the government to break ranks with the European Commission and also lean on other countries to do so, just using its weight as the largest European economy. We're just one week or so away from the July 4th deadline. Time is running out. But of course, there's a chance that Europe could also postpone the imposition of these tariffs until negotiations are concluded.
Canada is also clamping down on imports of Chinese EVs. This is part of the sort of broader alliance with US trade policy.
Yes, Canada has now announced that it is starting a 30-day public consultation period, which is really the first phase before they can eventually impose tariffs on Chinese EVs. And it's not just tariffs in focus. The finance minister announced that they will be looking at adjusting the eligibility criteria for consumers to participate in this federal rebate program when buying vehicles, because currently electric vehicles from foreign countries are eligible for those rebates. She's also looking into whether to restrict investments into the EV sector in general. So pretty sweeping changes that could be coming for Chinese EV makers. Now, of course, the immediate impact is not huge because Chinese EVs do not have a huge presence in the Canadian market. But this is likely to be intended to close that side door that Canada could offer, because Canada has a free trade agreement with the US and Mexico. So this would prevent any, a way for Chinese EV makers to circumvent those tariffs by the Biden administration.
Looks like more swings ahead for Chinese EV maker shares as well with the arrival of tariffs. Are we seeing that reaction across these stocks?
Yes, we are expecting huge swings ahead for these Chinese stocks. We have a chart. In fact, let's pull that out. If you look at the 3 months implied volatility of some of these stocks compared against the Hang Seng Index, for Li Auto, that is at highest level since February of 2023, and BYD as well remaining elevated after hitting a near 1-year high. Geely as well looking at one of its highest readings too over the past past year, and these stocks really have been struggling a lot this year. If you just look at another chart we've prepared here, the year-to-date performance for some of these stocks. For Li Auto, it's dropped by more than 50%. Geely doing slightly better, 2.6% increase, but that's still lower than the benchmark performance of 5.8% gains. And for BYD, it's doing better, 11% gains so far, but that's mainly because the EU tariffs had came in below industry average. But still, if you look at the options, it's still very expensive. We are looking at the number of outstanding calls at a 3-year, outstanding puts rather, at a 3-year high compared to calls. And we also saw very bullish trading, options trading for Li Auto as well on Friday with the creation of new call contracts.
All right, Bloomberg's China correspondent Min Lo there on escalating geopolitical tensions on the trade side. And we do have an alert on the Bloomberg right now. We're hearing from Reuters that the Biden administration is investigating China Mobile, China Telecom, and China Unicom over concerns that the firms could exploit access to American data through their U.S. cloud and internet businesses by providing it to Beijing. Now, this is according to Reuters, citing sources familiar with the matter that authorities at the Commerce Department are currently running the investigation, which has not been previously reported. They have subpoenaed the state-backed companies and have completed, quote, risk-based analyses of China Mobile and China Telecom, but are not as advanced in their probe of China Unicom. We'll bring you more as we get them. This is Bloomberg. You're watching the Asia Trade. The World Economic Forum's second biggest meeting of the year is getting underway in the Chinese city of Dalian. Let's head back to our coverage there. Our Chief North Asia correspondent Stephen Engel is standing by with our next guest. Steve.
You were very fortunate to have my next guest is Hak-Cheol Shin. He is the CEO of the big Korean petrochemical giant LG Chem, also the parent company of the big EV battery maker LG Energy Solutions. Thanks for being with us here.
Thanks for the opportunity.
In Dalian. What do you want to hear? What are you coming here to the World Economic Forum annual meeting of new champions to hear? We haven't been back, the forum hasn't been back in 5 years. A lot has happened geopolitically, a lot has happened in EVs. What do you want to hear?
Yeah, obviously the title of the whole event here is the next frontiers for growth. So in this kind of fragmented world, a lot of things going on. Frankly, mostly negative news is surrounding the whole planet. In the midst of all this, there's a hope. We can create growth depending on how we think about it. There's plenty of growth opportunities. So I think the next frontiers for growth, new ideas, innovative ideas, new talents and everything else. So I'm here fundamentally to engage with the people who believe in the future, who believe in the fact that there are plenty of growth opportunity for future and for mankind as well.
How do you assess growth in China? Obviously, it's sputtered at the beginning part of this year. It's trying to find its footing. And we do know that there's new productive forces been unleashed by the top government here in China. A lot of them have to do with the new economy as far as batteries, which you're very much in, EVs, solar panels, and the like. But do you see this as a great opportunity, or is that bifurcation, which you just talked about, kind of splitting your priorities?
I think it's a great opportunity. I think that's what everybody is hoping for. China finally bouncing back from pretty much the bottom in terms of economic growth, which we all have been familiar with for the last few years. I think the whole world needs China in terms of economic impetus. Every global company in Chinese operation is a sizable part of their global operation, and that is quite true for LG Chem as well. So as we see more momentum happening in China, whether it's demand increase in EV, whether it's consumer spending, it's a welcome news for China, it's a welcome news for everybody. in the industry, in the whole world.
Now, the last time you and I spoke was a little more than a year ago. I think it was in February of 2023 in Seoul. You said essentially that your first and foremost priority was to secure enough raw materials used in EV batteries, obviously associated with LG Energy Solutions. How would you describe the volatility in those raw materials and your pursuit to secure those raw materials now at a time, yes, China's trying to dominate the EV industry, but there are tariffs going up in the United States on EVs, potentially in Europe, upwards of 48%. Canada is talking about that. And the U.S. also has sort of tepid demand, slowing demand for EVs. How does that impact your strategy, your first priority?
So there are a lot of things in one of your questions. We're talking about availability of raw material, short-term and long-term. We are talking about maybe affordability of raw material in terms of pricing. Lithium price was $80 per kilogram. Now it's down to $14. It might go up. So we have a huge volatility in pricing as well as availability of raw material. Well, they will depend on the demand projection of EV, which is very different now than 2 years ago, and will continue to gyrate as we move forward. So the whole industry is dealing with this issue of a stable source of supply for critical raw materials in the midst of huge uncertainty and complexity in raw material availability, pricing, and even geopolitics and all the regulations, both in terms of short-term and long-term. So we are negotiating with a lot of those complexities and frankly, difficult issues going forward. As far as LG Chem is concerned, we are okay short-term, 2, 3, 4 years. We have enough supply, stable source of supply. However, any concerns, maybe supply plan, maybe 5, 10 years down the road, we have to find more sources of supply and more stable sources of supply. And that's not just confined to LG Chem. I think everybody in the whole industry is facing the same issue on a longer-term basis.
We also talked about the Inflation Reduction Act and how you were kind of navigating the wording of that for the Biden administration. Yeah. But what if Trump comes back? How much are you thinking about the potential return of President Trump in the White House and whether that would have an impact on subsidies to EVs and batteries?
Like any rules and regulations, depending on the administration and policies, there may be some fine-tuning, maybe some changes down the road. However, I don't think fundamentally the spirit of IRA and the framework of IRA will not change because fundamentally what it's looking for is to induce more local production in the United States, induce more foreign capital into the United States to localize the supply chain, to secure enough source of supply. So I think the fundamental framework will stay the same. However, there may be some slight changes here and there, and that's maybe inevitable in the midst of administration change.
Does it make you want to pause, though, some of the investment in the United States? You have a big facility in cathode plant in Tennessee, I believe. Does it make you pause, though, to see how the politics shakes out?
I don't think so. I think the reason we are investing billions of dollars in the United States is not just to deal with 2-3 year type of supply issue or to satisfy certain particular regulation. If IRA is one regulation, who knows, there may be others, right? So we are looking at the whole regulation issue as well as supply issue on a long-term basis. I think one thing that we haven't talked about a lot is what customer wants. Our customers are large global OEMs like GM and everybody else. They need suppliers to be closer to the customers. They want localized supply chain in addition to IRA type minimum requirements. So there are many reasons why we decided what we decided. So I think we'll stay the course regardless of the change in IRA.
We could talk forever, but very, very quickly, are you going to sell down some of your stake, your oversized stake, 82% in LG Energy Solutions? Is that necessary?
We don't have immediate plan for that.
Okay. No. Thanks so much, Mr. Shin, for joining us here at the AMNC.
Thank you.
Here in Dalian. Okay, Haidi, back to you.
Stephen Engel, our Chief North Asia correspondent covering the World Economic Forum in Dalian, or Summer Davos. More ahead here on the Asia Trade. This is Bloomberg.
Businesses are facing too many serious challenges to risk another 5 years of a chaotic and unstable government. And it's time to return to a government that solves problems rather than causes them.
Conservatives believe in capitalism. We believe in the power of business to do good. We don't think profit is a dirty word, and we are optimistic about our future.
UK Business Secretary Kemi Badenoch and the Shadow Business Secretary Jonathan Reynolds are during their UK election debate hosted by Bloomberg. Well, elections front and centre, be it you're talking about the UK or, of course, the snap election for the presidential vote in France, dominating risk sentiment here over these concerns over fiscal policy and how investors are going to react. We did see in the previous session European stocks actually rising and auto stocks in particular gaining with these hopes that EU-China tariff talks could yield some sort of compromise, but we are seeing downside in the future session again now. Euro Stoxx 50 futures off by more than 0.5%. We're also seeing some declines for German futures as well, Shery.
And Heidi, we're following the latest on this years-long saga. WikiLeaks founder Julian Assange will be freed after 5 years in a British prison as part of a plea deal with the U.S. Sources say he will plead guilty to leaking U.S. national security secrets. Bloomberg's U.S. legal news editor Peter Bloomberg joins us now for more on this. And it's been an ongoing battle, 15 years. What does a plea agreement come to then?
Well, essentially, it is an accord that spares him from being sentenced to a long term in prison in exchange for his finally acknowledging wrongdoing, acknowledging guilt, and he will be sentenced to the time that he has already spent in prison in the UK, and no more prison time when he is returned to Australia under the terms of the deal.
The potential resolution to this, as Shery mentioned, after more than a decade of legal wrangling, what are the implications when it comes to precedent and implications for future and other whistleblowers, for example?
Well, it doesn't have any legally binding impact on any other cases in the future. Plea deals are very specific to individual defendants, so the government is not in any way hampered from prosecuting future national security leaks.
What's the timeline now for Julian Assange then?
Well, his plea is scheduled to be entered in court tomorrow in the Northern Mariana Islands in the U.S. District Courthouse there. And then it is our understanding he will be immediately sent to Australia.
Peter, when it comes to this, you know, what feels like quite a sudden resolution obviously would not feel like it's sudden for his legal team or for Julian himself, but can we identify any kind of trigger as to how we've gotten to this point?
Well, we do know that there have been talks ongoing for some time that he and his lawyers have fought his being extradited from the UK to the US on concerns that he might not get a fair trial or might be a suicide risk. So oftentimes these negotiations do take some time before they pan out.
Bloomberg's US legal news editor Peter Bloomberg there. More ahead on the Asia trade. This is Bloomberg. Taking a look at Westpac consumer confidence rising to 83.6. We are sort of looking very closely when it comes to particularly the household sector health, the consumer health, given the cost of living crisis and the RBA staying on hold. We're also looking ahead to CPI inflation as well. That's expected to have climbed to 3.7% in May. Households, though, it does seem like remain broadly quite pessimistic when it comes to these rate rise fears. That 83.6 mark when it comes to the Westpac consumer confidence level is still far below that 100 line that divides pessimists and optimists. So a little bit of improvement, but Westpac senior economists are saying that it is still firmly in deeply pessimistic territory.
And Haidi, take a look at how some of these assets are trading early in the Asia session, because we're watching chip makers across Asia, with SK Hynix leading those losses after we saw overnight that Nvidia extended that ongoing route, entering correction territory. Now Nvidia's valuation back below the $3 trillion threshold under both Microsoft and Apple. We're talking about a $400 billion plunge in Nvidia. Take a look at crypto assets as well, because we're seeing a little bit of support in the Asia session, but this only after Bitcoin fell below that critical 60,000 level in the overnight session, and we had Bitcoin touching the lowest level since April. So a little bit of a mixed picture when it comes to those crypto-related stocks. And take a look at Japan power producers, because we're hearing from local media reports that the government is considering ways to ensure utilities can recoup unexpected costs from restarting nuclear reactors or building new ones, according to the Nikkei report. Now, let's head back to our coverage of the World Economic Forum in Dalian. Our Chief North Asia correspondent, Stephen Engel, is standing by with our next guest. Steve.
And our next guest is Michael Guo. He is the co-CEO of Ping An Insurance of China. Thanks so much for being here and joining us.
Pleasure to be here.
For your international television debut, I believe. So what is your assessment of the Chinese economy right now? Obviously, Ping An Insurance has life insurance policies, which are a key part of your business, but also investment returns. And the first part of the year has been a bit of a dip, and your net income was down about 23%. But you feel that profitability will pick up. How is that going to happen in this current environment here in China?
Well, Steve, it's great to be here. If you look at the Ping An Group is one of the largest and prominent financial institutions in China and globally. And of course, our earning capabilities are actually highly linked with the Chinese economy. But when we look at the Chinese economy, we cannot just take a time cut from one here and there. We have to look at things and put things into perspectives, look at the historical growth models, and look at how it can move forward. So we do have strong belief that the economy is going to regain its growth momentum moving forward. However, the quality of the growth will be much higher than what we had experienced before. And if you look at the whole things, we do believe economies go in cycles, right? And which with the size of this economy, we could have big and small turns. We could have, sharp turns as well. The question is, how do we navigate through the different cycles, and how do we regain from some of the downs, and when we go up, we can become healthier. And I think this is something that the government is working on, the whole business community is working on. The Ping An is certainly trying to put our efforts into helping the growth of the economy to back on track and in a much higher quality.
How about new business value? Essentially, of the profitability of new life insurance policies rose 21% in the first quarter, followed by 36% jump in 2023. Can this be sustained, I guess, is the overarching question.
Right. If you look at the life insurance industry in China, if you look at the depth and the penetration, you look whatever numbers, ratios you look at, and comparing to what's happening in the more developed markets, like US, Europe, or even Taiwan, Hong Kong, and you will see there's very strong growth potential for Chinese life insurance industry moving forward. So we do believe this is a very strong growth opportunity for us. And Ping An being one of the largest and prominent life insurers in China, and we do believe we are able to take good advantage of that growth opportunity. right? So you do see our value of new business being going up, our productivity of our life agents being going up, and also more importantly, their average income for the life agency is actually going up as well, which is very important to keep the agents at very high quality and a stable pace. So moving forward, we do have a good sense that our business is going to continue to grow strong and moving forward.
I know you say you don't want to look at necessarily one sliver of time, but the first part of this year, in particular January and into February, obviously the stock market was really sluggish and you had those low bond yields. It really eroded your investment returns.
Yeah.
How are you rejigging your portfolio to make sure that you're not consistently pressured on the investment returns that investors want?
Right. It's actually, it's very important, the investment returns for our life insurance business. But when we look at the investment, we take a much broader perspective, not just into stock market, right? Because we have policyholders with our policies for the 20, 30 years, and we have to make sure our investment strategy matches with the nature of our business. So in terms of duration matching, we have to weigh in the different risks versus the return kind of profile of our investment. We need to look at regulators' requirements into what can be invested, what actually we should avoid. So we got different things to look at and to actually trying to balance out return versus risk and also the duration of our return moving forward.
There's a lot of chatter in the market that perhaps the industry could lower the assumed rate of return on investment, given obviously the investment portfolios are down, and also, of course, there's still the higher liability costs.
Yep.
It could come down to about 3% is what the chatter is. It already moved down from 3.5 down to 3. Do you see that as a viable solution, if you will?
Well,
that assumed
actually,
rate of return?
This is actually a great question, right? Because if you look at the interest rate in China, it's going down for a period of time. And moving forward, there could be a possibility that the low interest rate environment is going to be around for a number of years. Now, the regulator of the insurance industry has been taking very active measures to proactively manage what we call the potential risk for the investment return versus the cost of the liability mismatch, right? So that's actually, we see a positive thing for the whole industry with the guidance of the regulator, trying to actually reduce the rates of some of our products. Actually gives us a healthy growth potential moving forward, not just the holding on a high quality of the liability, but trying to struggling with the investment return on the other hand.
Where do you see the next frontier, if you will, in the insurance industry here? We've been talking about catastrophic insurance as an opportunity. I mean, there's been a lot more climate change. There's been natural disasters. We're having flooding in parts of China now. Swiss Re is one international firm that has come in trying to look at the opportunities in catastrophic insurance. In the West, perhaps it hasn't given great returns because of the high costs associated and essentially the underpenetration here. Do you see that as an opportunity, catastrophic insurance?
Well, it is actually one of the areas we're looking into. But if you look at the broader picture of the whole Chinese economy and where the whole financial services, and particularly the insurance industry, is heading towards, actually we do see aging being a very important issue for the industry to address. So some of the numbers I can share with you.
Sure.
If you look at the whole 1.4 billion population right now we have, for people aged over 60 and above, actually it's 20%, more than 20%. And 15 years from now, that 20% number is going to be doubled. So that ratio, if you look at that comparing to what's going on in some of the aging economy, like in Japan, in the US, in Europe, it's actually quite high.
Yeah.
Now the challenge is most of the Chinese people are not really ready or very well prepared to deal with these aging issues. And that's something we believe as the insurance industry, we're able to actually help our customers to address. So we do see aging, how to deal with the aging issues and how to finance yourself in a longer life when people all want to live longer, but they also want to live healthier. So that's actually critical. So that's why one of in the recent changes, we have actually modified the whole group strategy from the integrated finance to medical health and also the senior care moving forward. So we got a dual kind of prolonged strategy moving forward to address the retail customers' needs.
Michael Guo, thanks so much. I'm dealing with that senior care right now. My mom's 96, and people are living longer, obviously.
Yeah.
Michael Guo, co-CEO of Ping An Insurance. Thanks so much for your time.
All right. Okay.
Here in Dalian. Okay, guys, back to you from Dalian.
Stephen Angor, Chief North Asia Correspondent covering the World Economic Forum or Summit Davos in Dalian. Some of the other corporate stories that we're following this hour. UBS has agreed to sell the majority of its stake in Credit Suisse's China venture to a Beijing-backed fund. The sale values the brokerage at around $253 million. Beijing's state-owned assets management company takes an 85% stake, leaving UBS with 15%. The deal is a blow to the ambitions of Ken Griffin's Citadel Securities to expand in China. The Fed is said to have shown other US regulators possible changes to its bank capital overhaul that would significantly lighten the load on Wall Street lenders. Bloomberg sources say the revisions could lead to a 5% increase in the capital cushion that large banks need to hold. That's down from about 16% in the original plan, which faced resistance from some lenders and Fed officials. More ahead on the Asia trade. This is Bloomberg. We've got some breaking news when it comes to this Boeing-Spirit Aero deal. Boeing's offer for Spirit said to value the supplier at about $35 per share. Boeing's offering to buy Spirit Aerosystems with stock, according to people familiar with the matter. So this is really kind of a last-minute twist when it comes to this idea that potentially the proposed funding its acquisition of the parts maker Spirit Aerosystems with stock rather than cash. This is according to people familiar with the matter. Spirit is a jet fuselage maker that it split off actually from Boeing 2 decades ago, and we've seen in recent days and weeks that they've closed in on an all-cash deal. But of course now we're hearing that they're proposing to buy Spirit Aerosystems with stock. Shery.
Right, Haidi, and we continue to watch another developing story here in Japan. The massive projected loss for Japan's biggest agricultural lender, Norinchukin, has yet to spell disaster for the country's large banks. Nochu, as it's known, has flagged that net losses of $9.5 billion could still get worse, but credit default swaps signal no spillover to the overall banking sector. Bloomberg senior analyst for fixed income research, Pri Da Silva, joins us now for more on this. Pri, why are other banks across Japan insulated from this crisis that seems to be a little bit more ring-fenced around Nochu at this point?
Yeah, hi. So in the case of Nochu, the problems at the bank stem from a negative carry in their investment portfolio, and that's largely due to their funding costs. Nochu's dollar funding costs, our foreign currency funding costs, came up to little over 5% last year, and that's a stark contrast to the other banks, and that primarily stems from their lack of core deposits in the overseas markets. And so Nochu relied on confidence-sensitive institutional funding, and that's expensive, and they weren't earning the same carry, and that led to the net loss. And what's lost in the story is the fact that Nochu generated a net loss in the last couple of quarters. So, but that's unique to them.
It's really interesting about this bank is that they also suffered massive losses after the global financial crisis, right? When it comes to trying to restructure their portfolio, how difficult will it be?
So the challenge is meeting the funding costs for them, and how do you generate enough earnings from a securities portfolio, and also meeting the bank regulatory capital needs. And so in order to do that, they need to add high generating assets with low capital costs, and I think that's the challenge for them. How difficult? There aren't that many options where you can generate over 5% on a risk-free basis. So one of the likely outcomes is they probably may need to deleverage the balance sheet.
If they're looking to raise more capital, first of all, are they going to do that, do you think? And who might that try and tap for that?
So there is talk that they intend to raise capital, and the only option for them is to go to their cooperative members, and that's a requirement for them by law. So as a result, that's their only source of capital. Can they do that? They probably could.
Yeah, we'll be watching for news on that because that will have big market implications on how investors really accept those news, right? Our senior analyst for fixed income research, Preet De Silva, there with the latest on Nochu. Now, a new Bloomberg Intelligence report says Tokyo employers may be able to cut staffing costs by allowing more flexible working arrangements with employees willing to sacrifice pay for remote work. To dig into the BI survey results, let's bring in Patrick Wong, senior analyst for Asia Pacific Real Estate and head of Bloomberg Intelligence Hong Kong. Patrick, I mean, really when we were hit by COVID-19, not many offices went fully remote across Japan. What are these findings telling us about the willingness to actually allow some employees to do this?
Yes, we did the surveys a couple of rounds after the pandemic, and this time we also observed some difference versus the past two surveys. And interestingly, I think the situation now is that we see the employees, those office workers working in Tokyo, they are now more willing to take the flexibility. So say, for example, they are willing to take the pay cut for a certain amount of them. They are really willing to getting the opportunity to working at home more often than before. And also the company perspective, I think they are also need to pay, basically they need to increase the salary for some of the employers to attract them to work in the office 5 days a week. So that is also a difference, because last survey we see that it's only 20% of them saying that they are willing to work in the office 5 days, and especially if they get the pay rise. But this time on we see that it's from 20% going up to 35%. So we see more office workers that really want to get the flexibility. So that is a key difference.
What are the major implications when it comes to office landlords in Tokyo?
So for the office landlords in Tokyo, I think the main difference is that we also observe the workers there, they are treasuring that the opportunity working at home. But if they are really willing to back to office, most of them have the challenge that they have the long commute time, say 1.5 hours or even longer. So basically for office landlord perspective, they are really need to get the office in a prime location, say next to the Tokyo train station, that will also attract more demand for the office. So we observe that for the second half of this year, we could see the Tokyo office demand, the vacancy rate is also coming down for the major real estate companies like Mitsubishi Estate. So that's also potential catalyst for those situations for office rent to improve.
Patrick Wong, BI Senior Analyst for Asia Pacific Real Estate and the head of BI Hong Kong. More ahead on the Asia trade. This is Bloomberg.
Emerging market stocks trading a little bit flat this week, but we actually saw a little bit of a boost when it came to currencies across emerging markets. The Colombian peso led those gains. There's a lot of optimism right now that we might see looser monetary policy, especially in the likes of Brazil, Colombia, and Mexico. So those LATAM assets have seen a little bit of a boost in recent days. Veteran emerging markets investor Mark Mobius now saying that traders need to widen their scope as the world of opportunities grows. Mobius spoke to Bloomberg's latest Tiger Money podcast. Here's a preview.
I think it doesn't make sense to just say, okay, I'm just going to go into India or go into China or go into emerging markets. You got to look global. And of course, yes, emerging countries are growing faster than the developed countries. No question about that. It's double the growth rate. So therefore, there's going to be more opportunities in the emerging countries, but there's so many companies listed in New York and London and other developed markets where the companies are actually emerging market companies because their earnings are from the emerging countries like India, China, Brazil and other countries like that. So we've got to widen our scope if we want to be good investors.
So I'm wondering, what is the argument, or what's the best case you can make against U.S. exceptionalism? That there is a case to be made to be long EMs and simply not just leave your money and close your eyes and wait, say on an S&P 500 ETF, for example.
As I mentioned, the S&P 500 now contains so many companies that are benefiting from the growth in emerging countries. So you've got to be aware of the fact that when you buy Apple, you are buying not the U.S. market only, but you're buying China, India, et cetera, et cetera. So these countries are enabling the American companies, the multinational companies, to earn greater and greater profits. And therefore their stock reflects that.
So your Mobius Emerging Opportunities Fund that's about to come online, are you saying that, everything is fair game? So a company like Apple, which you correctly point out, you're effectively buying an EM stock if you think about it longer term, because increasingly their pie is China, India. Tesla is another one, for example. Would the S&P 500 companies, or would stocks in the U.S. be part of your eligible investment universe?
Yes, definitely. Yes, there's no question about that. And don't forget ADRs. Lots of ADRs are listed more and more. You're going to see emerging market companies listed in New York because of liquidity.
Mark Mobius, Capital Partners co-founder Mark Mobius. We're speaking with our colleague David Inglis. You can hear that full conversation on Bloomberg's Tiger Money podcast, out every second Tuesday, along with the previous episodes. It's all available at the outlets listed on your screen there. Taking a look at how futures are shaping up, given this sort of a meandering sort of mood across Asian markets. Of course, a big sell-off in Nvidia overnight, certainly not contributing that much to a positive sentiment, but we are seeing a little bit of upside there. S&P futures looking pretty flat at the moment. TAIEX futures looking perhaps unsurprisingly on a bit of downside given the sell-off across mega cap tech and Nvidia. We're seeing FTSE A50 China futures actually looking mildly optimistic. There is some hope, particularly across some of the EV makers. We saw the European automakers surging overnight on hopes that these talks between the EU and China could yield some level of compromise on these tariffs. But largely speaking, we're seeing trading more or less trying to defy what was really that mixed day on Wall Street. A lot of speculation, though, that the tech sector may be running out of steam with that rally, so watching tech very closely in the Asia trade. That is just about it for the Asia trade. Our markets coverage continues. We look ahead to the start of trading in Hong Kong, Shanghai and Shenzhen. The China show is next. This is Bloomberg.